Markets are in the red, as you saw just a moment ago, as investors wait for rate decisions to come on Wednesday, both in the U.S. and here in Canada. The likelihood of a rate cut by the Federal Reserve seems to be priced in. The Bank of Canada is so far expected to hold. Let's dig in with Jay Bala, CEO and Senior Portfolio Manager at AIP Asset Management. Thanks for joining us today.
Oh, thanks for having me in.
Okay, markets seem fairly quiet today. Do you think investors are kind of just waiting to see what happens Wednesday? Because most people seem to believe there is a rate cut south of the border we're holding here. So what's to wait for?
Sure. I mean, I think it's a good question. I mean, I think there's always that anticipation of, what happens next. Will, the Fed or the central bank say anything in those meetings? But I think you're correct. I mean, I think it's pretty much factored in at this point. Canada's probably going to hold, and the U.S. is going to cut rates.
Okay.
Right.
Where are you seeing rotation going these days?
Sure. I mean, I think where you've seen a ton of rotation is people that have looked forward a few years and they're saying, well, okay, what's my fixed income portfolio going to look like for the next few years, right? Are these interest rates going to come down and then come back up? Or are they going to come down and stay down for the next few years, like we've seen, after the great financial crisis, after we've seen after COVID, where you've had that steady state, right? Like where interest rates came down and then stayed really low for a very long time. And I think, where you're seeing rotation is a lot of people are looking to figure out ways of getting income streams, right? And so they've looked at convertible debt. People are looking at private credit. People are looking at anything that's going to give them sustained income streams for the next few years, right? Because if you think about a traditional portfolio, kind of a 60-40 model, where 60% of your portfolio is in equities and 40% is in fixed income, well, if interest rates are going to come down and stay down, well, your 40% is in some serious trouble if you don't do something. So we've seen a lot of intelligent investors already start asking those questions and to ask about really, what are my option sets for the next few years? How do I lock in rates and at least sustain that low interest rate environment for the next few years? Okay,
so Bank of Canada, everyone thinks will be a hold. And then next year, do you think there is a possibility of rates moving up?
I don't. And I always go back to sort of first principles and, maybe look at sort of the simple mathematics behind interest rates, right? So if you look at the U.S. economy today, it's a $35 trillion economy. Its debt is also $35 trillion. And so, the U.S. economy is a developed economy, which means they can only grow at 2 to 3% a year, maximum. So if they have a place where interest rates are higher than 3%, well, that just means the debt's going to outgrow the economy, if all else equal. And so they have to force the rate down. So the interest rate has to be lower than growth rate. And so, one way or the other, they have to maintain low interest rates because the other choice is an uglier choice. It's austerity. You'd have to cut expenses. You'd have to go and talk to the general population and the voter base and say, hey, listen, vote me in, I'm going to cut everything. And, that is not a very easy thing to do. And so from the Canadian perspective, if U.S. is going to keep their interest rates low, ours cannot be much higher. Otherwise, it'll cause our currency to become stronger, which means, we export less. It's a tougher sale process for us, right? So, we're going to have to compete with the U.S., meaning, if their rates are going to stay down, we're going to stay down.
Where are you landing these days on AI? We saw a lot of trade moving away from some of the big tech in the last number of months.
Sure.
As you said, moving more to sort of things that are cyclical or things that they feel better about over the longer term. Mm-hmm. What are you seeing these days and what are you doing with AI trade?
Sure. So with AI, I think we need to do two things. We need to separate the stock price itself from the actual use case. And so I'll compare that to the internet from the 2000s because that's the easiest comparison, right? So, in that period, you had seen the stock prices go way too high, then they came way too low, and then they reset again. But if you look at that entire period from, say, the early 2000s to now, the internet has never, ever stopped growing. It's always grown. It just never grew as fast as people thought, and then it grew better than people thought, and then it kind of leveled out. And AI is the same thing. It's a change, right? Like, if you look at your kids or if you look at sort of young people, they use it more and more. I use it in my daily life, and it's not going anywhere. So, for the next 20 years, it's a growth pattern. Now, will these stocks overshoot? Maybe, right? Will valuations come down? Possibly. And, it's also difficult to kind of figure out winners. And so that's why we always suggest two things, right? if you look at AI as a pure play, every single one of them is private. There isn't a single pure play AI company that's public, right? If you look at OpenAI, xAI, and Anthropic, those are your three biggest ones. Not a single one is public. The second one is, look, it's very hard to determine which one of these is going to be the winner, who's going to be the Amazon of AIs, call it. And so the answer is, look, diversify. Buy all three, or find a way to have a nice diversified pool, and then that's kind of your longer term bucket. That's you're in it for the next 10 to 15 years, and you're going to do incredibly well owning those three names for a very long time. Right?
Okay, so I like the buy all three, sort of dip in at each, but then watch and determine sort of which one, as you say, is going to be the Amazon, and then perhaps shift your money over?
I mean, I think there's a natural loss rate, right? Like the winner's valuation goes up, the loser's valuation goes down. And so you have a natural kind of loss rate as you go up. But the reality is this, the winner is going to be a 10-bagger. The loser is going to be a loser. But, you'll make more than enough money on the winner that'll offset the losses of the other two.
Interesting. Okay. All right, Jake, I'll leave it there. Thank you for coming in.
Perfect. Thank you so much.